Hello everyone and welcome back to the sessions on Advanced Strategic Financial Management. Friends, in continuation of the topic Advanced Capital Budgeting Part 2, in this class we are going to discuss about dependent versus independent cash flows. Now what we have learnt in earlier classes was the role of probabilities in estimating the expected value of cash flow. So basically, we have observed that there can be different economic scenarios in the future, the most favorable one to the most adverse one. And each economic scenario will have a different estimate of cash inflow that can be generated. Each economic scenario which has a different cash inflow will be associated with its different probability. So what we do? Respective cash flow will be multiplied to the respective probability to arrive at expected value of cash flow. But that was one approach for determining expected NPV. Now here we are going to introduce a different approach for computing the same expected NPV, but now a little differently. Now see what can happen. There may be, say, three possible economic scenarios: the best scenario, the most likely scenario, or the worst scenario. For the best scenario, the cash flow estimates will be given. Then the most likely scenario, cash flow estimates will be given. Likewise for the worst scenario. And suppose the life of the project is 2 years and the cash flows and economic scenarios are independent over time. So in the first year, there may be three possible outcomes: the best outcome, the most likely outcome, or the worst outcome with their associated probabilities. Then, assuming that in the first year, the outcome happens to be the best case scenario, then again from there in the second year, anything can happen. It could be following again a best case scenario for the second year, or most likely case, or worst case. Anything can happen. When I say anything can happen, means the cash flow of the second year is independent of the cash flow of the first year. Correct? When cash flow of the second year is dependent on the cash flow of the first year. In other words, how much will be the cash inflow in the second year? If it depends on the cash inflow in the first year, we will call it a case of dependent cash flows. Whereas if the cash flows in the second year or in the following year are independent of the earlier year cash flows, we will call it as independent cash flows. So what I am going to do is I am going to show you one small but very nice example of identifying how to approach expected NPV calculation using EVCF and using dependent and independent cash flow assumptions. What I'll do is, specific to the given scenario, I'll give elaborate explanation when the time comes. So what we do is we first take up a calculative example given in your book in question number 21. Let us read this question. It says, life of project equals to 2 years, cost equals to rupees 10,000, discounting rate equals to 10% per annum. Estimates of cash flows, you have two different economic conditions, good and bad, with the associated probabilities given along with the estimate of annual cash flows. You are required to determine expected NPV using EVCF. Then through separate NPVs of each possible outcomes, assuming cash flows are independent over time, and then through separate NPVs of each possible outcomes, assuming cash flows are dependent over time. So in the question, the three requirements which are put forward, the first one I don't have to explain you. You have been doing that calculation already. Correct? Determining expected NPV through EVCF. So what you will do, first you compute EVCF. Cash flows have been given along with their respective probabilities. You multiply the probabilities to cash flows, you get EVCF. Project life is 2 years. Whatever EVCF you get, It is commonly applicable for both the years. Because it is commonly applicable for both the years, you can use annuity factor for determining the present value of cash flows, and PV of outflow in the form of cost of the project is already given to you. So it won't take any time to make that calculation. Let us first finish that simple calculation, and then we will look into what is the solution for the second part and third part. But let us first do the easy thing first. Expected NPV using EVCF. So EVCF is 9,000 into 0.6 plus 3,000 into 0.4. The two cash flow estimates getting multiplied to their respective probabilities, and the aggregate resulting into expected value of cash flow. The annuity of rupee 1 for 2 years at 10%, we can get 1.7355. When you apply that annuity factor over the EVCF, the total PV of EVCF, which indicates the PV of inflow, comes to 11,455, and the PV of outflow, that is the initial cost, is given as 10,000. So the expected NPV will be 1,455. So this is just a simple task. Quickly write it up so that I can take you ahead. Alright friends, once you have completed writing the solution for the first part of the question, let us now carefully read the second part of the question once again. It says you are required to determine expected NPV through separate NPVs of each possible outcomes, assuming cash flows are independent over time. So the second part of the question clearly mentions the scenario that the cash flows are going to be independent over time. So if you notice in the question, there are two possible economic scenarios. One is good, one is bad. In the first year, if a good scenario is experienced, the second year can turn to be either good or bad, because what will happen, good or bad, is independent of what has happened in the first year. In other words, the economic scenario and hence the cash flow estimates of second year are completely independent of what has happened in the first year. So there is a possibility that in the first year, if the economic scenario was good, in the second year it can again be either good or bad. In the first year, if it was a bad scenario, in the second year again independently it could be either good or bad. In all, we will have 4 different outcomes. Good economic scenario in the first year, then again good economic scenario in the second year, then good economic scenario in the first year followed by a bad economic scenario in the second year, then maybe a bad economic scenario in the first year but a good economic scenario in the second year, or bad economic scenario in the first year as well as bad economic scenario in the second year. That means the combination of economic scenarios over the 2 years life could be good good, good bad, bad good, bad bad. 4 possible outcomes. What we will do is we will compute NPV of each outcome, and then we will apply joint probabilities. And joint probabilities applied on NPV of each outcome, we will be getting the expected NPV. And you would wonder when you get the result. I'll not say anything now. Let us do one thing. Let us land up at that calculation and you will experience it yourself. So when you are dealing with a question like this, the first thing that you need to do, get started with the initial outlay of 10,000. Because it is an outflow, I have placed that 10,000 with a minus sign indicating a negative cash flow. So that is at 0 year. From here we have 2 possible economic scenarios, either good or bad. Good has a probability of 0.6, bad has a probability of 0.4, making sure that all possible scenarios taken together, the overall probability should be 1. Now, the cash flow resulting in the good economic condition is 9,000. In the bad economic condition, it is 3,000. So, both of these are cash inflows that are possible in the first year. Both of them won't arise. It is either 9,000 or 3,000 with these respective probabilities. Now if this is the outcome in the first year, outcome of second year, which is independent of the outcome of the first year, you know, after getting a cash flow of 9,000 in the first year, what can happen in the second year? Again a good outcome which results into again a cash inflow of 9,000. We are calling this as path 1. That is good economic condition in first year followed by good economic condition in the second year. That is path 1. It could be a good economic condition in first year followed by a bad economic condition in the second year. We identify this as path 2. Then bad economic condition in the first year followed by a good economic condition in the second year. We are identifying this as path 3. And then finally a bad economic condition in the first year followed by another bad economic condition in the second year as well, and that is path 4. Now what is happening? We have identified these 4 different paths and you are going to compute the NPV of each outcome. So there are 4 possible outcomes, you compute NPV of each outcome. Then we will also determine the joint probability for each path. How do you identify joint probabilities? If you focus on the screen, let me explain that as well. See, the economic condition being good, the probability is 0.6. So landing up at this outcome, that is you are getting cash inflow of 9,000, the probability is 0.6. From here, the outcomes get split into 2 further possibilities. That will be 0.6 of this 0.6 and 0.4 of this 0.6. So for path 1, the joint probability will be 0.6 of 0.6. In other words, it will be 0.6 into 0.6, that will be 0.36. Then for path 2, it will be 0.4 of 0.6, that will be 0.24 as joint probability for path 2. Then for path 3, it will be 0.6 of 0.4. Again, it will result into a joint probability for path 3 as 0.24, and for path 4, it will be 0.4 of 0.4, that will give you 0.16 as joint probability for path 4. So I will show the calculation of joint probability and NPV in the next working, but I want you to systematically draw this diagram. Drawing this in the lucid manner is important for dealing with questions like this. Please draw it quickly and then I take you ahead. Alright friends, once you have completed writing this diagram, let us move ahead, and now we show the calculation of joint probabilities and NPVs of each path, and that will be followed by the computation of expected NPV. So for the first path, as I have mentioned, the joint probability will be 0.36. In the first path, the economic outcomes under both the years were good outcomes. So 9,000 of cash inflow multiplied to the first year PV factor. Again 9,000 of cash inflow in the second year multiplied to the PV factor of second year. Aggregate of these two will be the total PV of inflow minus 10,000, which is the PV of outflow. You get NPV of path 1 as 5,620. Likewise, you will be computing the joint probabilities and NPVs of each path. When you do that, you will find that some outcomes are resulting into a negative NPV. So there may be 4 possible outcomes, one giving you positive NPV, second, third giving you smaller amount of positive NPVs, fourth outcome is a negative NPV. All these NPVs are associated with their respective joint probabilities. You know, if you total up these joint probabilities, it would always total up to exactly 1. Now, when you multiply joint probabilities to each of the corresponding NPVs, you will be getting the expected NPV values, and when you total up the ENPV column, it will give you the expected NPV. And as I told you earlier, this is the same amount what you obtained earlier through the other approach, that is expected value of cash flows. So please write up this entire table and then I take you to the next part of the solution. Alright friends, once you have completed writing this part of the solution, let us move ahead and now write the next heading. We are computing expected NPV assuming cash flows are dependent over time. Now here you have to be little alert about the information given in the question. When cash flows are dependent over time, in this particular question, what will be amounts of cash flows in the second year if the cash flow of the first year are so and so? They haven't given any such information. So because the cash flow information for the second year typically is not given, and we are being informed that you should assume that cash flows of second year are dependent over the cash flows of the first year, and that is the title what we have written over here. You know what you will do? It is basically the economic scenario of second year is dependent on the economic scenario of the first year. So if the first year there was a good outcome, it is implied that in the second year also it will be a good outcome. In the first year if it was a bad outcome, in the second year again there will be a bad outcome. So there will be only two paths over here, good and bad. So because it is good, it will be good, good. If it is bad, it will be bad, bad. So because the cash flows are dependent in the second year, the cash flows are dependent over the cash flows of the first year, and separate cash flows of second year have not been informed, you will simply consider the economic scenario of second year is dependent on economic scenario of the first year, and that is why there will be only two different paths for two possible outcomes, that is good and bad. So how to present this part of the solution, I'll show you. You start with a negative cash flow of 10,000 at 0 year. If it is a good outcome, it is path 1. If it is a bad outcome, it is path 2. Now, some students, they end up asking me a doubt over here that, sir, what happens to second year? Here you have considered only the first year, because actually it should be good and followed by good. So good probability is 0.6. Again 0.6 applied on that, it will become 0.36. No, that is not the case. Let me explain this point to you once again. Let me explain this. See, if the first year the outcome is good, having probability of 0.6, then being a dependent scenario, that is the economic outcome of the second year or economic scenario in the second year will be dependent on the economic scenario in the first year. If the first year it is a good outcome, it is 100% sure that in the second year again it will be a good outcome. That means probability of happening good outcome in the second year is 1. So 1 multiplied to 0.6 remains 0.6. Likewise, in the first year if there was a bad economic condition, in the second year again it will be a bad economic condition. So probability of bad economic condition in the first year was 0.4, but probability of bad economic condition for the second year, which is dependent on the outcome of first year, which being bad, the probability will be 1. So 1 multiplied by 0.4, the joint probability also becomes 0.4. So there will be only two paths with good and good outcome or bad and bad outcome. And because there are only two paths, there will be only two joint probabilities, that will be 0.6 and 0.4. By mistake, if you take joint probability as 0.6 into 0.6, 0.4 into 0.4, the aggregate of joint probability will never be 1, where joint probabilities aggregate should always be 1. So we have only two paths with their respective joint probabilities as 0.6 and 0.4. So please write up this small diagram and then we go for the calculations. Alright friends, time for us to move ahead, and now what we do is we make that table and compute the NPV of the two paths along with the expected NPV. Joint probability in this scenario remains 0.6 and 0.4. I have explained you that already. Even in this case, the expected NPV won't change. It will still remain 1455. So please write up this table as well, and it will be end of the solution. Alright friends, once you have completed writing this entire solution, let us move ahead and take up the next question, that will be question number 22. Let us read this question. In fact, this is exactly the same type of question, with the only difference that here you find that three different economic conditions have been given, that is good, average and bad. So you have to do the same thing what you have done in the previous question. You have to compute expected NPV through EVCF, and then through the separate NPVs of each possible outcome, once assuming that the cash flows are independent over time, and once assuming that the cash flows are dependent over time. So do one thing, you just write up this solution for the first part, where you will be computing expected NPV using EVCF. I'll give you just 2 minutes time for the same. So your time starts now. Alright friends, your 2 minutes time is over. I'm sure you would have computed the expected value of cash flow and the expected NPV already. EVCF comes to 760. Annuity of rupee 1 for 2 years at 10% will be 1.7355. So you get total PV of EVCF as 1318.98, and total PV of outflow, that is initial cost, is 900. So the expected NPV comes to 418.98. If you have obtained the answer as 419, that is all fine. So make sure that you have got this, and then I take you ahead. Alright friends, once you have completed writing this whole thing and you got this same answer, let us move ahead, and now we write up the heading expected NPV assuming cash flows are independent over time. Quickly write up this heading, expected NPV assuming cash flows are independent over time. Under this heading, first we draw the diagram starting with the initial investment of 900, which indicates a negative cash flow. There may be three possible outcomes: good, average and bad, with their respective probabilities and the respective resulting cash inflows. Now because the cash flows are independent over time from each of these nodes, there may be three possible outcomes, that is good, average or bad. So good, average and bad. From each of these three nodes from end of year 1, by the time you end up at end of year 2, you find that 9 total number of paths identified over here. So I'll give you a few minutes to copy this diagram, and then just like the previous question, you will be carrying out working note for finding NPV of each path, and then the joint probability of each path, and then you will compute the expected NPV. So total time that I am allotting to you for writing down this diagram and making all the calculations, it is 10 minutes, and your time starts now. Alright friends, I have given you enough time to write up the required calculations. Let us move ahead and look into what you would have done, whether it is correct or not. So first thing that is needed is determining NPV of each path. So I don't have to explain you these calculations. In fact, when you have attempted, you should have got all these calculations correct. So the workings that we are showing, they have one thing in common, that each path, the initial investment is same, that is 900 rupees, and then the cash inflow is different in each of these 9 paths depending upon the diagram that you have shown. So here you get the NPV of each path identified. So if you have already worked it out correct, then you need not wait, you can just move ahead. If you haven't done it correctly, I am giving you time, just take note of all these calculations properly, and then we move ahead. Alright friends, once you have completed these calculations as well, let us move ahead, and now what we do is we compute the expected NPV. This is very simple. You have obtained 9 different paths, and you have also obtained the NPV of each path in the previous working. Now joint probabilities you know how to compute, I don't have to explain it to you. Then NPV marked as A and joint probability is marked as B. You multiply A and B, and when you take the summation of these products, you will be getting the expected NPV. The expected NPV works out to exactly same amount, that is 418.98. If you have got this already, you can just move ahead. Else, I am giving you time, take note of all these calculations and then we proceed ahead. Alright friends, once you have completed this entire calculation, let us move ahead and deal with the last part where we compute expected NPV, assuming cash flows are dependent over time. So you start with the cash outflow of 900 at 0 year, and there will be only 3 outcomes, that is good, average and bad. That is 3 different paths identified as 1, 2 and 3. NPV of each path you have already computed in the earlier workings, probabilities, and multiplying these to get expected NPV, and expected NPV would work out to the same amount, that is 418.98. So please write up this entire calculation and that will be end of the solution. Alright friends, once you have completed this entire solution, let us move ahead and take up the next question, that will be question number 23. Let us read this question. A firm has an investment proposal requiring an outlay of rupees 80,000. The investment proposal is expected to have 2 years economic life with no salvage value. In year 1, there is a 0.4 probability that cash inflow after tax will be rupees 50,000 and 0.6 probability that cash inflow after tax will be rupees 60,000. The probabilities assigned to cash inflows after tax for year 2 are as follows. Look at one thing. For year 1, they have already defined that there can be 2 possible outcomes. Either the cash flow will be rupees 50,000 with a probability of 0.4, or the cash flow can be 60,000 with a probability of 0.6. Now, in this table, they have actually informed you the cash flow of year 2. And look at one thing, cash flow of year 2 could be 24,000, 32,000 or 44,000 with the respective probabilities if the cash flow in the first year is 50,000. Likewise, the cash flows in the second year could be 40,000, 50,000 or 60,000 with associated probabilities, provided the cash flow in the first year was 60,000. So here it is clearly a case of dependent cash flows where question has given specific information. Let us read the question further. The firm uses a 10% discount rate for this type of investment required. Construct a decision tree for the proposed investment project and calculate the expected net present value, that is NPV. What net present value will the project yield if the worst outcome is realized? What is the probability of occurrence of this NPV? What net present value will the project yield if the best outcome is realized? What is the probability of occurrence of this NPV? And lastly, it is asking, will the project be accepted? And question has given you discount factors for year 1 and year 2. When question already informs you the discount factors, you just use the same PV factors. Don't try to put anything from your calculator. Now, how would you present the solution of this particular question? Rupees 80,000 is the initial investment, and in the first year there can be 2 probable cash flows, either 50,000 with a probability of 0.4 or 60,000 with a probability of 0.6. If the cash flow in the first year is 50,000, the cash flow in the second year could be 24,000, 32,000 or 44,000. any of these three cash flows with these probabilities. That means these cash flows will arise only when the cash flow in the first year was 50,000. So this is clearly a case of cash flows being dependent over time. Means cash flows of second year are dependent upon the outcome or the cash flows of the first year. Likewise, if the cash flow in the first year was 60,000, cash flow in the second year could be 40,000, 50,000 or 60,000 along with these associated probabilities. So what we find, there can be in total 6 different paths. So we identify the joint probability for each path. Now you know how to compute joint probability. For example, if it is path 1 where cash flow in the first year will be 50,000 with a probability of 0.4 and cash flow in the second year will be 24,000 with a probability of 0.2. So the joint probability of path 1 will be 0.4 into 0.2, that would give you 0.08, and so on. You compute the joint probability for each path, making sure that the aggregate of joint probabilities should always be 1. So please write up this diagram and the calculation, and then I take you ahead. Alright friends, once you have completed writing these calculations, let us move ahead, and now we show the working for NPV of each path. So I don't have to again explain you any of these calculations. You know how to do these calculations. The NPV of each path you calculate based on the discount factors given in the question, and later on what we will do is we will also compute the expected NPV based on the NPV calculations that we have made out of this working, plus the joint probabilities that we have worked out for each of the 6 paths in the previous working. Now carefully understand one thing. The worst case appears to be path 1 because it is giving you highest negative NPV, and the best case is path 6 which is giving you the highest positive NPV of 24,100. So keep in mind one thing, the question has even asked you the worst outcome and the best outcome, which will be path 1 as worst outcome, path 6 as the best outcome. So before I take you any further, please write up this entire working quickly. Alright friends, once you have completed writing this entire working, let us move ahead, and now what we do is we work out the expected NPV. So when you are computing expected NPV, you identify the NPV of each path and you then apply joint probabilities to these respective NPV values, and you get the product as expected NPV when you take the total. So before I take you any further, quickly write up this calculation. This is nothing new for you. One important point I would want to highlight at end of this whole writing work. So once you write, I will just explain one very important matter over here. Alright friends, once you have completed writing this entire working, let me now explain something very important. Look at these NPV figures that we have in this column, and the highest negative NPV is observed in path 1, highest positive NPV is observed in path 6. That makes path 1 as the worst outcome and path 6 as the best outcome, provided your focus is on the NPV column. But let us put our focus on the expected NPV column. After applying the joint probabilities, the highest negative value is coming for path 1, which continues to make it worst, but the highest positive value is occurred in path 5, which may put you to think that path 5 will be indicating the best outcome. Now, what should be the right approach to identify what is the best outcome and what is the worst outcome? Are we supposed to consider NPVs or NPV values after multiplying joint probabilities? The correct answer is without touching joint probabilities, the core NPV calculation, where you look into the highest negative and highest positive NPV, identify those as the worst and best outcomes. In other words, identification of worst and best outcomes should be carried out without considering the associated probabilities or joint probabilities. This is because, let me give you example in a little different context. You are a student at final level and you will be sooner writing your final CA or final CMA exams. Now, I give you a range of marks 10, 20, 30, 40, 50, 60, 70, 80, 90 and 100. And I also plot the probabilities of scoring these marks in your exam. If I ask a student, what do you think will be the best outcome, where even 100 marks is included in that list of outcomes with a very small probability, 0.01, 1% chance that you may get, say, 100 out of 100. Now, probability is very low, but the outcome is the best, right? So, which is the best outcome? Nobody can say that 60 is better than 100. 100 will remain the best outcome even though the probability is very, very low. So, for example, at 60 marks, the probability is 0.3, correct? So, 60 into 0.3 will give you what? Something different, something higher value, right? It will give you what? 60 into 0.3 will give you what? 18. And 100 marks into 0.01 will give you what? 1. So, 60 into 0.3 gives you 18 and 100 into 0.01 gives you just 1. That doesn't make 100 as an inferior outcome. You give anyone a choice what you would want to score, 60 marks out of 100 or 100 marks out of 100. Anyone will say 100 out of 100. So, understand one thing. In real life as well, the best possible outcome when you try to search, it is obvious that it is not a most likely case scenario. We have been learning this right from the point when we have learned scenario analysis. In scenario analysis, you tell me, always the best outcome will have low probability, correct? And the most likely outcome will always have a high probability. But we don't call most likely as the best. It is most likely. So, in this whole thing, the most likely outcome could be different. If the question is asking you best and worst outcome, it should be identified without considering probabilities. So, keep this thing in mind. What I am going to do is, when I show you the solution over here, I will give you the solution as per my viewpoint, because that is correct. What you should do is, this question is given in ICAI study material and you can refer the solution given over there. If someone would not want to follow my opinion and would want to still follow what ICAI has done, I am not going to stop you anyway, correct? It is your choice. But let me tell you, out of some few past exam questions, this was the only one where the solution contains this error. All other questions in the past exams, they have identified best as best and worst as worst without any ambiguity. Now, CMA students, if you look into your institute study material, your institute study material has given both the versions in two different examples. In fact, they gave exactly this example with the solution given by ICAI, that is Institute of Chartered Accountants of India. And they have then taken one more example by just taking all the figures what are appearing over here divided by 2. So, where it is 80,000, they have put a figure as 40,000. Everything else remaining same. Now, in that question, they gave the viewpoint that I am suggesting you to follow. So, if you are CMA students, without doubts you follow what I am saying, because your institute anyway has mentioned that solution in their study material. CA students, I am strongly advising you to follow what I am saying. If you are sensible enough, you would have understood by now that yes, what I am saying makes complete sense. But still, I'm not stopping you with respect to what you would want to write in your exams. So fine, this writing work is over. So let us move ahead and write up the conclusion. In the conclusion, you first write, if the worst outcome is realized, the project will yield NPV of negative 14,726. The probability of occurrence of this NPV is 8%, that is path 1. If the best outcome is realized, the project will yield NPV of rupees 24,100. The probability of occurrence of this NPV is 6%, and that is path 6. The project should be accepted because the expected NPV based on joint probability is positive at rupees 6,223.76. So the only difference between the answer that I have displayed on screen and the answer that you will be finding in your institute study material is with respect to the second point in this conclusion. So please do one thing, please write up the conclusion, and that will be end of this particular solution. Alright friends, once you have completed writing this entire solution, let us move ahead and take up the next question, that will be question number 24. Let us read this question. It says, life of the project is 2 years, cost equals to rupees 9,000, discounting rate is 10% per annum, estimates of cash flows that are independent over time. You have two economic conditions, good and bad, with their respective probabilities and annual cash flows given. Determine the expected NPV through separate NPVs of each possible outcome and the standard deviation with respect to NPV. And the second part of the question is asking you, determine the standard deviation with respect to NPV using Hiller's model. Now what we identify is, when this question is asking you to consider the cash flows that are independent over time, that means outcome of second year will not depend on the first year. Anything in the form of economic condition can happen, good or bad. So what I understand is, determining the expected NPV through separate NPVs of each possible outcome. This is something that you have already learnt in past few questions. What is new for you? It is a standard deviation with respect to NPV. Though it is just computing standard deviation, but yes, in the series of all these classes, we haven't touched this part yet. So we will be learning how to do that, and something that is completely new for you is application of Hiller's model. So let us do something which we have already learnt earlier, and we begin with a diagram that indicates the outflow of 9,000 at 0 year. If the economic condition goes good with a probability of 0.6, the cash inflow will be 8,000. If it goes bad, the cash inflow will be 4,000. Further, these are the possible cash flows at end of year 1. From each of these nodes, there can be either a good economic condition as a follow-up or a bad economic condition with same probabilities and cash flow patterns. So if it goes good, you will get cash flow of 8,000. So 8,000 cash flow in first year, 8,000 cash flow in second year, both having good economic conditions. We are identifying this as path 1. First year good, second year bad, we are identifying that as path 2. First year bad, second year good, we are identifying that as path 3. And both the years bad, we are identifying this as path 4. So quickly take note of this diagram and then I take you ahead. Alright friends, once you have completed writing this diagram, let us move ahead, and now what we do is we compute the expected NPV. So we first of all determine the joint probability for each path. I don't have to explain you how to do that. Then we compute NPV for each path, and the NPV for the first path will be obviously highest because it is a follow-up of both good economic conditions, 4,884. Second path having joint probability of 0.24 and NPV of 1578. Third path having joint probability of 0.24 and NPV of 1248. Fourth path, joint probability of 0.16 and a negative NPV of 2058. When you multiply the joint probabilities with the NPVs, you will be getting the expected NPV as an aggregate of these values. That is A into B. A represents joint probability, B is NPV. Expected NPV will be A into B as aggregate. 2107 will be the expected NPV. So please write up this entire calculation and then I take you ahead. Alright friends, once you have completed writing this working, let us move ahead, and now what we do is we determine the standard deviation of NPV. Now carefully understand this working. We have 4 different paths, 1, 2, 3, 4. We have identified NPV of each path. Now NPV of each path in this particular table we are identifying as X, okay, and ENPV we are identifying as X bar. So ENPV what we got was 2107. So if these are X values and these are X bar values, X minus X bar will give you the deviations from the ENPV. So X minus X bar will give you the deviation from the mean, and mean over here is the expected NPV. So what are the values that we get for X minus X bar? The deviation for the first path is 2777. For the second path it is negative 529. Third path it is negative 859. And for the fourth path it will be negative 4165. Once you get the deviations, you know what are the probabilities for each of these paths. When I talk about probabilities of each path, these are basically the joint probabilities. Now, when we multiply the squared value of deviation, that is d squared, to the probabilities, we will be getting p into d square, the summation of which will give you the variance with respect to NPV. Similar thing we have done when we have computed the variance with respect to the cash flows, correct? When we have taken the variance with respect to expected value of cash flow, we did similar thing. Here the base of the computation is NPV, which is being compared with the ENPV. Over there the base of calculation was cash flow compared with expected value of cash flow. So when you take the total of this last column, that is p into d square, the summation of p into d square will give you variance of the project NPV, that is sigma NPV squared. And you know one thing, that variance is a squared form of the standard deviation. So if you want to find the standard deviation with respect to NPV, it will be the square root of the variance. Variance is 57,96,032. Square root of that would give you 2407.49. This is the standard deviation with respect to NPV. So please write up this entire calculation. It will be end of the solution for the first part. What we now need to do is understand how to apply Hiller's model over here. But first you take note of this quickly. Alright friends, once you have completed writing this part, now let me explain you what exactly we have done. In the early stage of this chapter, we have learned how to determine standard deviation with respect to expected value of cash flow. And now what we have just learned is how to determine standard deviation with respect to the net present value. So when standard deviation with respect to EVCF was comparing cash flows and EVCF, that is cash flow and expected value of cash flow. When it is standard deviation with respect to NPV, it is comparing NPV of each path with the expected value of NPV, that is expected NPV or ENPV. Now this calculation has solved the purpose fully, but do you know this takes quite long time. And imagine this was a case with just 2 outcomes with a span of 2 years. So 2 raised to 2, the outcome was 4 different outcomes. If I make 3 possible outcomes and if I just take 2 years time, what will happen? It will be 3 raised to 2, that will be 9 possible outcomes that we have seen in earlier question. To the extent it was computing expected NPV, not a problem, but if I ask you to find what will be the standard deviation with respect to NPV, then making standard deviation computation with 9 different paths will be little longer and little challenging. But imagine if I take 3 outcomes with 3 years time horizon, it will be 3 raised to 3, that is 27 outcomes. Over there with 3 outcomes, if it is 5 years time horizon, it will be what? 3 raised to 5, that is what? 3 raised to 3 is 27 into 3 into 3, that is what? 81 and 243. There will be 243 outcomes that you will be getting. 243 outcomes. Can you imagine? It will be such a big mess in your in fact, in exam, if a question is asked like that, you will just leave it. That is where we need to understand that there is a great approach to determine this standard deviation with respect to NPV, and that is through Hiller's model. So what I'm going to do is I'm going to explain you how to apply Hiller's model and make the calculation very, very short and precise when it comes to determining standard deviation with respect to NPV. Keep in mind one thing, Hiller's model is not going to give you accurate calculation because it is a little bit of approximation based calculation, but it is still highly workable. And how to determine standard deviation with respect to NPV through Hiller's model, let us first theoretically understand these steps. So let us first write the heading, determining standard deviation of NPV through Hiller's model. Step 1, determine standard deviation of EVCF for each year. Step 2, multiply each year's standard deviation of EVCF with the corresponding PV factors. Step 3, calculate squares of the products obtained in step 2. Step 4, take aggregate of squares, that is sum of squares as obtained in step 3. The outcome is the variance of the present values, and take the square root of variance of present values as obtained in step 4, and the result is the standard deviation of NPV. So these 5 steps will solve the purpose. So please write up these steps first and then I'll show you how to apply the same. Alright friends, once you have written these steps, let us move ahead and identify the calculation of EVCF. So EVCF, I don't have to explain you. There are 2 possible outcomes, good and bad, each given with their respective cash flows and respective probabilities. When you apply this calculation, you get 6,400 as EVCF. Now, when you compute the risk for projects through EVCF and the standard deviation with respect to EVCF, the cash flows are 8,000 and 4,000. EVCF is 6,400. So when you compute deviations, that is CF minus EVCF, you get 1,600 for the first path and negative 2,400 for the second path. So the first path over here indicates the good outcome, second path indicates the bad outcome. The probabilities are 0.6 and 0.4. D square into P. So these are the deviation values. D square into P will be 15,36,000 and 23,04,000 for the 2 respective outcomes. And when you take the summation of D square into P, what you get is 38,40,000. This is the variance with respect to EVCF. Standard deviation with respect to EVCF will be the square root of this variance, that is square root of 38,40,000, that comes to 1,959.59. Now this particular calculation is nothing new for you. Quickly write it up and then I take you ahead and show you how to apply the later stage of Hiller's model. Alright friends, once you have completed writing this part of the calculation, you know what you have to do. This is the standard deviation with respect to EVCF. For year 1 and year 2, the cash flows are same. Cash flows are not different. For year 1 and year 2, cash flows are same. So the standard deviation with respect to EVCF will also be same. Correct? Standard deviation with respect to EVCF will also be same. What will happen next? You should identify that each year's cash flow has been converted into EVCF, and once you have computed the standard deviation of EVCF, which will be same amount for both the years, you try to find the present value of that standard deviation. But when you find the present value of that standard deviation, Mathematically, deviations cannot be added and subtracted directly. Why? Because deviations can be positive, deviations can be negative. That is why before addition or subtraction, we always convert the deviations into squared form. That is where the step 2, 3, 4 and 5 of Hiller's model become applicable. So let me explain you through the calculation how do you apply the later 4 steps in Hiller's model. So the first step you have already computed, that is the standard deviation with respect to EVCF for both the years. So year 1 and 2, standard deviation with respect to EVCF is 1959.59, PV factors at 10%. Then you apply the PV of standard deviation of EVCF. That means you are applying PV factors on the standard deviation. You will get the present value of standard deviation with respect to EVCF. Because these present values cannot be added or subtracted directly, you are taking the squared form of this. So the squared form of these present values, when you add up, you will be getting the variance of the project NPV, and then when you take the square root of that variance, what you will get is the standard deviation with respect to NPV. This is what you got through the other calculation as well. There will be a little bit of difference because Hiller's model is having some approximation getting involved. So here, because there were only 2 outcomes and 2 years time, the calculation as per Hiller's model and the actual calculation of standard deviation of NPV, what you have already completed earlier, does not have any significant difference. So please write up this whole part, and that will be end of this solution.